Are you looking to add some reliable income to your investment portfolio? If so, dividend investing may be worth considering. Dividend investing involves selecting stocks or other securities that pay dividends, which are cash payments distributed to shareholders as a portion of a company's profits. By choosing dividend-paying stocks, you can potentially receive a steady stream of income from your investments. We will delve into the key concepts of dividend investing, including dividend yield, dividend growth, and dividend payout ratio, and discuss various dividend investing strategies such as high-yield dividend investing and dividend growth investing. We will also introduce you to the concept of dividend aristocrats and explain how you can use a dividend reinvestment plan, DRIP, to automatically reinvest your dividends and potentially benefit from compound growth. What is a dividend yield? Dividend yield is a measure of the annual dividend paid by a company as a percentage of its stock price. It is calculated by dividing the annual dividend per share by the current market price per share. For example, if a company's stock is currently trading at $50 per share and it pays an annual dividend of $2 per share, its dividend yield would be 4%. 50 equals 0.04. Dividend yield can be an important factor for investors who are looking for income from their investments, as it represents the amount of cash they will receive on a regular basis in the form of dividends. However, it is important to note that a high dividend yield may also be a sign of a company with financial difficulties or a declining stock price, so it is always important to carefully evaluate a company before investing. What is dividend growth? Dividend growth refers to the increase in the amount of dividends paid by a company over time. Companies that consistently increase their dividends demonstrate a commitment to returning value to shareholders and can be attractive to investors seeking income from their investments. When evaluating a company's dividend growth, it can be helpful to look at the company's history of dividend payments as well as factors such as its earnings, cash flow, and payout ratio. Dividend growth can also be a good indicator of a company's financial health and stability. However, it is important to keep in mind that a company's ability to continue increasing dividends in the future is not guaranteed and may be influenced by various factors such as economic conditions and competition. What is a dividend payout ratio? The dividend payout ratio is a financial measure that indicates what proportion of a company's profits are being paid out as dividends to shareholders. It is calculated by dividing the amount of dividends paid by the company's earnings per share. A high dividend payout ratio may indicate that a company is returning a large portion of its profits to shareholders, which can be attractive to investors seeking income from their investments. However, a high dividend payout ratio may also suggest that a company has less flexibility to reinvest in its business or retain earnings for future growth. On the other hand, a low dividend payout ratio may indicate that a company is retaining a large portion of its profits for business expansion or other purposes, but may not be as attractive to investors seeking dividends. It is important to keep in mind that the dividend payout ratio can vary significantly across industries and is not necessarily an indication of a company's overall financial health. What is Dividend Reinvestment Plan, DRIP? A dividend reinvestment plan, DRIP, is a program offered by some companies that allows shareholders to automatically reinvest their dividends into additional shares of the company's stock rather than receiving the dividends in cash. DRIPs can be a convenient way for investors to gradually accumulate more shares in a company without having to manually make additional purchases. Some DRIPs also offer the option for investors to purchase additional shares with cash at a discounted price. Participating in a DRIP can be a good way for investors to benefit from compound growth, as the reinvested dividends can generate additional dividends in the future. However, it is important to keep in mind that the value of the shares purchased through a DRIP will fluctuate with the market and there are typically fees associated with participating in a DRIP. What are high dividend stocks? High dividend stocks are stocks that have a high dividend yield, which is the annual dividend per share divided by the stock price. These stocks may be attractive to investors seeking a high level of income from their investments. However, it is important to keep in mind that a high dividend yield can be a red flag and may indicate that the market is expecting the company's dividends to be reduced in the future. This could be due to a variety of factors, such as a decline in the company's earnings or a decrease in its financial stability. It is therefore important for investors to carefully evaluate a company's financial health and outlook before investing in high dividend stocks. In addition, it is important to diversify one's portfolio to reduce risk, as relying on high dividend stocks as a significant source of income may not be suitable for all investors. What is dividend income? Dividend income refers to the cash payments that shareholders receive from a company as a distribution of its profits. Dividend income can be an attractive source of income for investors, particularly those seeking a steady stream of income from their investments. Companies may pay dividends on a regular basis, such as quarterly or annually, and the amount of the dividends may vary depending on the company's financial performance. Some investors may choose to reinvest their dividends by using a dividend reinvestment plan, DRIP, which allows them to purchase additional shares in the company with the dividend payments. It is important to keep in mind that dividend income is not guaranteed and may be influenced by various factors such as the company's financial performance and market conditions. In addition, the value of the dividends may be affected by inflation. What are dividend aristocrats? Dividend aristocrats are companies that have consistently increased their dividends for at least 25 consecutive years. These companies are seen as reliable and consistent dividend payers, and may be attractive to investors seeking a steady stream of income from their investments. To qualify as a dividend aristocrat, a company must meet certain criteria, such as being a member of the S&P 500 index and having a certain level of market capitalization. Dividend aristocrats may be less risky than other dividend-paying stocks, as their long track record of dividend growth suggests that they have strong and stable financial foundations. However, it is important to keep in mind that past performance is not necessarily indicative of future results and that the ability of a company to continue increasing its dividends is not guaranteed. What are dividend investing strategies? Dividend investing strategies involve selecting stocks or other securities that pay dividends as a way to generate income. There are several approaches that investors can take when it comes to dividend investing, including dividend growth investing. This strategy involves selecting stocks that not only pay dividends, but also have a history of consistently increasing their dividends over time. These companies may be seen as more reliable and financially stable. High-yield dividend investing. This strategy involves selecting stocks with a high dividend yield, which is the annual dividend per share divided by the stock price. While these stocks may offer a higher level of income in the short term, they may also carry more risk. Diversified dividend investing. This strategy involves building a portfolio of dividend-paying stocks from a variety of industries and sectors to spread risk and potentially reduce volatility. It is important for investors to carefully consider their investment objectives, risk tolerance, and financial situation before selecting a dividend investing strategy. Thanks for watching and please subscribe for more money-making ideas.